Now we're going to go abroad and we're going to look at U.S. exports and then what's happening in the international markets. And before we get into that, again, please, we'd like to remind you, like, share, subscribe. Your support is always appreciated. So when we're looking at the export side, you can see things really kind of slowed down, but there's a mixture of pricing and timing delays. So when we talk about gasoline, we were talking about a little bit of a slowdown just based on where we're sitting, which was, there was a reduction of 43,000 barrels a day, still above the year-over-year and 5-year average, which we've been talking about, maintaining above the seasonal norm, but just kind of normalizing. And then distillate had a small increase of 13,000 barrels a day, but again, as we were saying, staying below that seasonal average just because there's not as much demand for distillate, especially as we normally send a large amount of ours into Europe. And given the way the ARB is flowing, it really doesn't make sense to do that, which is, again, capping some of those components. Now, jet fuel had a big decline. That's not surprising given the flight data that we've been talking about. Propane is one where we were thinking that there was going to start to be an increase. It obviously declined about 200,000 barrels a day. That is due to two different components. One, prices have gotten elevated, and we've also have timing delays. So those are things that will stop some of those flows. But again, it'll just stop some of them. It won't really stop the whole component. So we expect this to reverse and actually set those, go above the year-over-year average for the most part. And then, and as we talked about with crude oil exports, we had exports of about 2.62 million barrels a day, back within kind of that comfort range of 2.6, 2.8, which is down 866,000 barrels a day. So if you think about exports were down 866, and then when we consider where imports were, which was down 650, there, you're getting an idea of where some of this strangeness is coming in, where we should have seen a little bit of a build given the fact that refiners weren't enough to offset. But this is something that we're going to have to look at and really kind of consider, what does that mean for next week? And are we going to get an increase of one of these that's going to offset, and we're going to see some of these builds. But even if we see a build over the last 4 weeks, it's been a steady drawdown on the oil side. We're still at a net build on the product side, which again is just looking at both sides of that barbell to understand where is the total demand and where could there be a potential problem as we start to see some additional activity within different economies. So when we look at motor gasoline, you can see we're, again, pulling back a little bit. There's not much to say just based on what we're seeing in tanker trackers and flows. It's just going to be fairly sideways, still above that 9-year average. Then when we talk about distillate, we fell back. We remained below the cloud. Just based on what we're seeing, there's nothing to say that we're going to really do anything outside of bump along the bottom of that cloud level, and it most likely get a little bit worse just because we do have some Middle Eastern flow, some Indian flow coming into Europe and into some of our markets, but yet we have Europe coming into ours and Latin America. So again, we're just going to see pressure remaining on U.S. exports, which will also push more distillate in, or keep more distillate in storage, which is offsetting some of that drawdown that we normally see this time of year, or we were hoping to see this time of year, and staying fairly flattish even on those levels. And then when we look at crude oil export, back within kind of that comfortable range where we think we're just going to go sideways from here and chop around between, on an average, 2.6 to 2.8 as we go through, just because there's that baseline effect. But given the tightness that we had seen in previous months, which they're opening up a little bit, not much, but they're opening up a touch where we're going to see some additional flow through, but just not as much, just given where spreads are versus the rest of the world. Then when we look at propane, we were expecting to stay at the top of that cloud. Instead, we fell a little bit further back in. Again, we expect to see that reverse and go a little bit higher. But this is where we're going to see some interesting activities over the next few weeks. Now, when we talk about, product, we always have to look at what is happening abroad. So when we look at storage, there's commentary that there's been a drawdown in some of the floating storage in Singapore, which is true because we've seen some naphtha and some cargoes, just given where naphtha has started to price, move out of storage and into the market, specifically in South Korea. And in India, we've seen some of this pull through of storage floating side. Here you can see that we do have an elevated, and we remain elevated on the onshore, just given where some of the data remains. And here it's just, we're still maintaining a seasonally adjusted all-time high on Singapore product, just based on what we're seeing with some of the pressures in China remaining, some of the pressures in other areas, specifically South Korea, on other components, not talking naphtha, but on other sides of the demand cycle. That's going to keep this elevated in total. And that's why when we look at the international light gasoline, we were expecting it to see a shift higher. We got it. We're now back above the seasonally adjusted high. And just given where the gasoline movements remain and where China sits and how they're trying to push some of the additional capacity into the market, as we have a reduction in South Korea, just given what we talked about with COVID and some of the other limitations, that's going to remain elevated as we go through the next few weeks. Now, on the middle distillate side, it went pretty much sideways, which is what we were saying, where there's some bullish sides and there's some bearish sides, and just based on the weightings of both, we think it's enough to just keep things the way they are at this point. And just highlighting some key points, because Singapore has a lot of flow back into India. And right now, India is actually seeing an increase in exports of gasoline, which again is shifting the movements. And we should start to see that reverse a little bit, and we should see more gasoline pushed into India. And this is why we're going to talk about that, because gasoline prices at fuel stations operated by Indian Oil Corp, which is obviously a very large corporation and one of the biggest there, were at a record of 87.60 rupees a liter on Wednesday. So when we think about demand and when we think about inflation and some of these other components within India itself, we have a record at the gasoline pump. And if we think about the issues within India, starting to alleviate, it's going to be hard to see a lot of these individuals that are going to be able to afford that without passing through some of that price. While diesel was priced at 77.73 rupees, according to tracking fuel prices within the country. So again, these are in components that are going to weigh, because when they ask the government, are you going to reduce taxes to help reduce some of these prices? So far, the answer is no, because, and as we talked about in our econ show, Modi's government has actually increased spending for the year and has increased the deficit. So by decreasing taxes, the problem is, well, you already had a widening deficit. There's always a little bit of a concern, or way more of a concern, I should say, of inflation in that country, which means that there's less of a chance of being able to even reduce prices, which is again going to weigh on that net demand as we go forward. So 18 million tons of oil products in January were consumed versus 18.5 million tons a year ago. Now, January was actually an easy comp month last year, and they still fell below it. Now, there's caveats to that, because gasoline consumption was up 6.3% year over year. So this is something that we're expecting to slow down, just given where prices are, at the fact that they're at a record. But that's only 2.61 million tons, where when we look at diesel consumption, it was down again 2% year over year, and that's 6.8 million tons. Now, the reason why I say January last year was an easier comp is because diesel demand last January was actually fairly low versus where it was in previous years. So when we put that into context, the demand for diesel is the lowest since September. And if you think about where September was, that was when we started to see an increase in cases. We were seeing a slowdown in economic activity, and that was also cautious ahead of going into October, which is when there is the holiday season, and Diwali really ends that. So again, just something to consider. But naphtha consumption was at 1.27 million tons, which is 8.1%, which is down 8.1% year over year, which is down the most since August. Because this is starting to reverse, but The problem is naphtha prices remain elevated, which is keeping some of that capped. And then LPG consumption was up 1.8% because LPG is going to continue to be strong. But the things to watch when we're thinking about India on an economic level is going to be naphtha for chems and is going to be diesel for economic movements. And they're both still weak and getting a little bit weaker. So this is going to be one to watch as we go through to really appreciate what is the Indian economy doing, and are we going to see a big rebound in Indian demand in the near term, which right now the answer is no. And then when we look at middle distillate, because middle distillate for when we're thinking about what is the flow through, what is that economic powerhouse going into the Indian markets, the Chinese markets. That's why we did have a little bit of a decline, as we were saying. We would have along the top of that cloud, and there's nothing to show that we're going to get any kind of shift within that backdrop. Now, as we were talking, when we look at the inventories in Europe, there was a slight increase. Net. They continue to manage that gas oil component. As we look at gas oil, fuel oil in general, again, they're trying to maintain this flatness by keeping refinery throughput low, keeping some of the activity of exports robust into the U.S. based on the arbitrage, and really limiting those imports coming from India. And here's getting an idea where gasoline still remains a problem, especially just given where we sit on the driving side, where holidays are going to be restricted in a lot of areas just to maintain some of the spread. The UK variant continues to increase in its movements through the populace. So the question is going to be, is that going to become a bigger problem in March? Because one of our base cases back in November was a holiday spike, a really bullish move in February, and then another spike in March, just as kind of we had. Just think about your normal year. When a lot of people get sick, at least I know myself as well, is the change of seasons, which is that March, April. So we think that there's going to be a spike in March. It won't be by any means to the level that we saw on the holiday. The idea was that was going to be the blow off top in terms of cases, but then we were going to get another surge in March and just peak out much lower versus where we were in that December, January timeframe. So then when we look at crude oil in ARA, which is in Europe, again, as we were saying, flat. We thought there was going to be a little bit of increase. Instead, we just went sideways, which just makes sense just because there's not a whole lot of movement happening within those markets. Now, looking at Fujairah, you can see that it's still elevated versus where it was in October, December, November, but we're starting to move a little bit lower. And there's some counterpoints to that in terms of where is that going to continue, or are we going to start to see some adjustments? So total inventory was 21.2 million barrels, which is down 9% from the week earlier, which is, again, the lowest since November 30th, if we look at where we were in November. However, when we look at traders and some of the commentary, there was some caution just looking at physical gas oil crack is expected to emerge stronger this year. The product still faces an uphill recovery battle with the product spread to crude still trending sharply lower. And again, looking at the crack spread, looking at the movements, looking at those demand levels, and that speaks to what's happening within the Asian markets. And then when we look at inventories, which they came in at 4.4 million, which is a 3-week low, we expect to see that kind of normalize, but really not spike higher, just go sideways from here. Stockpiles of heavy disti, including fuel oil for power gen, dipped by about 9%, which is a week earlier and the lowest since November 30th. That was the biggest driver, as we had a big increase for power generation, just given the sweeping cold that has hit a lot of key areas of demand. But more importantly, light distillates, including gasoline and naphtha stocks, fell to 7 million barrels, which is down 5% and lowest in 3 weeks. Now, this is the one that we think is going to reverse, just based on the gasoline movements and what we're seeing in the flow. A lot of this drawdown was driven by naphtha, which will remain strong, but the gasoline is going to offset. So this is going to be a good one to watch. Now, going into the loading data, when we look at flows in general. So Libya is the interesting one. They're saying that they're going to export about 1.2 million barrels a day. They did have a strike that shut down ports. And as we were actually filming this specific segment, news just came out that they have made agreements. They are going to issue the back pay. So a lot of these ports are now reopened. So again, there'll still be a timing delay, like how many ships were there waiting and then left and have to now come back. So there's enough time in February to make up most of that. It's just going to be, how much of that maybe slips into March, because you weren't able to pick up all of your backlog. So right now they're producing about 1.28 million barrels a day, 1.26 million barrels a day. So there's more than enough crude available in order to put it onto a boat. It's going to be a timing delay. So it'll still be above January, but it'll probably be a little bit below where they're targeting for February. Norway had some slippage over Nigeria, something similar, because Nigeria is actually struggling to sell some cargoes, and so is Angola, which we'll talk about in a second. Russia is actually consuming a bit more locally, which has reduced some of those flow-throughs. But a Fortes pipeline is now back operational after going down for a few days, which will help move some of the crude when we're looking at Europe and the North Sea in general, and we'll talk about that in a few minutes. But Angola, again, seeing that slippage from February into March, and March being difficult for them so far. So we can obviously look at the paper markets. The paper markets are telling you that we're up and out and the world is beautiful and everything is fine. But then when we look at the physical markets, we're starting to see some pushbacks back and forth as to where is this going to shake out. So what does that mean? Well, Angola has yet to sell about 40% of its cargoes from March loading. That is a problem, as a lot of that is sold into China. And we'll show a chart of how much flow is going into China, and it's a huge surge, which if you look at their activity in November, which we all saw, and as we said, as we saw a slowdown in December and January, that a lot of those cargoes are now on their way. And with a lot of that showing up, just as they still are struggling to work through their current overhang, given and now with the resurgence of COVID, the reduction of Lunar New Year, that's going to become a bigger overhang when we look at Chinese purchases going forward, while India should stay still below year over year, but still stronger than where China is at this point. So when we look at what's happening right now, Libyan crude sales fell last month because of port disruptions. Again, that moving through the system. Exports from key Persian Gulf OPEC nations slipped in January, and they slipped into January just because, again, moving into February. But we're going to talk about that in a minute in terms of where things are going in general. So when we talk about what are some of the flows that are happening, we see here, looking at Shell bought Urals in Northwest Europe at lowest price in 6 weeks. That has started to flatline. So we had a big knockdown of pricing on the physical market. And now that we've come to this low, we're starting to see some bids show up, which is putting some support on the physical market at these reduced levels. At the lowest price in 6 weeks on Platts window. Also bought another cargo for delivery to Augusta. Offered Siberian Light as cider loadings for March planned at 8.4 million barrels. Fortes diffs dropped nearly 50 cents. Rest of BFOET dropped as well. Urals from north down from the north was down 20 cents. From south down 50 cents. Nigeria fell 50 cents. Sahara down 10%. And as you can see, this is where we're seeing a lot of this pressure come through, which is why we're seeing some of that small backwardation in 4 to 8 weeks out on the physical side. But we'll talk about some of the spreads on the paper market, which obviously are still in deep backwardation, because we have some small backwardation, weeks 4 to 8, contango 1 to 4, and then overall contango between weeks 1 and 8 in general. But 4 to 8, again, is still in that slight backwardation, pulling some of those cargoes into the market. But when we talked about the movements going into Asia, this is where we're seeing one coming out of tanks and going on the water. And here we're looking at crude oil on the water is accelerating. And it's because there is way more oil in transit, which, again, going from storage into transit. And then the question is going to be, how quickly can it be offloaded? And right now it looks like there's going to be some bottlenecks on the receiving end, which we'll talk about. Then when we look at oil in transit, here's that big spike that we were talking about coming. We don't see that really stopping, just given where the crude is going from. There's a lot going still from Europe, or I should say North Sea, into into Asia, and specifically China, as they continue to purchase some of it. West Africa has struggled to sell into Europe, even though they have maintained some of their pricing, as we saw with some of the OSP announcements, which we'll talk about in a bit more detail in a different show, as some of that data flows through. And then crude oil on floating storage, it came down, but it still remains elevated, not back at those lows. And again, we think that there's going to be a steady increase in floating oil and storage as a lot of this crude that's in transit starts to show up. And that's why we're always looking at timing to see where those movements, because the paper market remains strong. Physical market had that quick move down, that quick kind of washout, and has found some stability now, again, kind of widening the difference between the two. Now, the amount of crude oil held around the world on tankers that have been stationary for at least 7 days fell to 88.75 million. The last week's was revised up to about 1.13 million. Again, this is just a matter of movements, which is where we're seeing some of these levels, and we just think that we're going to continue to grind higher as we go forward. Now, when we look at time spreads, March versus April, you can see that up and out. We're now just getting further and further into backwardation. This is looking at less about the physical, more on the paper side, and you can still see that there is that elevated levels of just where backwardation is. We've seen a lot of trades on the options land that are placing bets that this was going to happen. So we've seen some of these movements right now. Again, the question is going to be how much of this has staying power, and then how much of it can actually remain while the physical market still is struggling a bit as we look at Asia on the whole. And then when we talk about Asia and we talk about some of those components, we have to look at some of those, what is the demand dynamics. And as we said, with the crack spreads remaining weak, here you can see that there's a kind of a steady downward movement in activity, or I should say margin, at the refinery level, which is just going to limit the amount of activity that they're going to be looking to do, given the fact that there's just not a whole lot of money to be made in this market. And here's just to give an example of the Dubai hydrocracking refinery margins. Now, we had that spike. It's just, as we were saying last week, we didn't see it getting much better, but we also didn't see it getting much worse, and that's where we're starting to see some of that flattening out. Now, the physical market, again, had to price lower to try to get some of these cargoes into the market. And now that they're back into the market, we're going to get into a new week. The question is, are we going to start to see some support coming into some of these levels? And just right now, we're not seeing too much support that there's going to be an ability to raise some of that pricing. Now, as we said, the Urals came under pressure, pricing at 6-week lows, which helped some of these refinery margins, if you're just looking at the calculated components, where now you have two of them that are 4 that are above zero, two of them that still remain within zero, but they're starting to roll back over. Again, coming to where is that net demand that we're kind of expecting over the next few weeks. This is what we mentioned with the China super tanker movement. So now we have 127 tankers signaling China. That's obviously very elevated and is tracking closer to what we saw in April and May. And this is where we have to look at what is the impact going to be from a reduced Lunar New Year, because a lot of these cargoes were purchased in November, December, and now, I should say first 2 weeks of December, because then as we said, we saw slowdowns in end of December into January. Where is this crude going to go? Is it going to sit on the coast? Is there enough room in storage? Is there a mixture of both? And that's where we're looking at these China flows, because this could create a bigger problem as China tries to work through some of this excess, again, reducing overall purchases over the next 6 to 8 weeks. And then as it shows up, that's going to keep this Asian floating storage elevated as we look over the last few years. India is going to be a little bit better, but still not what it was last year. South Korea remains weak in terms of just flow through of oil. Naphtha is a little bit better. And Japan still struggles on a lot of levels, which again is keeping them fairly flattish. This North Sea, as we were saying, we expected to see that drop along the 5-year average. We got it, as we saw a lot of those super tankers are actually coming from the North Sea. So clearly there's some that have gone from storage to transit, which is what we talked about at the beginning. And then here, West Africa, we saw some sales come through on the Angolan side, moving some of that spot cargoes. They're still struggling to sell March right now, and they should be further along based on where we are. So again, this is going to remain elevated, and this is where we're seeing that concern when we're talking about that Asian demand component. On the Middle East, we're pulling out some of these crazy years from, obviously OPEC. You can see that just there's really nothing to say. It's pretty stable, and there's, based on the data we're seeing with obviously Saudi Arabia removing 1 million barrels a day from that capacity, that's going to keep that fairly stable at those levels. Europe had a pretty big drop down. This is one that will start to reverse as we have some pipelines normalizing. But again, it won't really reverse to the point where it's going to go anywhere really above the 5-year average. We think it's just going to bump along the bottom of that cloud for the most part. And when we look at slowdown in production growth, this is what we're talking about when we look at what's happening in China. So when we look at the 11 city metro passengers, you can see that's down a large amount. When we look at oil refinery run rates, that's starting to dip lower. That's going to accelerate to the downside in terms of growth. And then when we look at rebar inventory, we're going to talk about this in more detail. Inventory is starting to get pulled through just because the margins just aren't there to keep creating at the levels they're creating. So they're gonna pull from inventory. So just inherently seeing some of this tightness come in, and that will obviously, this is adjusting for seasonal norms, but this is going to be a problem as we're thinking about Chinese activity, which as we look at Shandong or the teapots independent refiners, essentially sitting flat of crude in storage, and that's going to speak to issues as how fast can that crude go from the boat onshore, given some of the fact that it still remains elevated, even though they made those purchases. And as we can see here, speaking to economic activity, the fuel oil side is heading in the wrong direction, and it's going to continue to drive higher, just given the lack of demand in the market and the problems that remain in the middle distillate market on the export side. So again, we're still remain cautious, just not so much on the oil, because the oil data remains or has gotten a little bit better, but it's also turning into product that is sitting in storage, and we're not seeing the same type of pull down on the emerging market side, where we're seeing some of that drawdown in OECD, obviously not as much on the product side in the US, but we are seeing it on the oil side in the US. So again, there's some of that balancing act on which side of the barbell matters more. And just given the overhangs from COVID, we have to look at product to see how quickly can that draw down, because as those products storage build up, it's going to slow down the oil runs or the crude runs, which is going to put more crude back in storage. Again, that's why you have to see some of this working together to try to get back to a normalized storage level. So I know we covered a lot. If you have any questions, please let us know in the comments, and then we're going to cover some, in more detail in the economy show, some of the economic overhangs that remain and that we continue to see, not just in the U.S., but also on a global level. So thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.